Same to you, Kelly. And I think it's really a story that the labor market remains strong. This was a really positive report. Healthy job creation, broad-based job creation, private sector jobs are now above the pre-COVID level, and the unemployment rate was able to hold at 3.6%. Wage growth was strong. I mean, some modest slowing in the last few months relative to where we were, call it 6 months ago in terms of wage growth. But I think it really should create some comfort that the economy still has some momentum here.
And what do you take from the Fed speak that we've had? Raphael Bostic on CNBC this morning, Waller and Bullard yesterday. Again, maybe this is a hawkish group, especially Waller and Bullard, but they definitely talked still about this 75 basis points being on the table.
And that makes perfect sense to me because the Fed is still in catch-up mode. They were intentionally, behind the curve for a period of time, maybe more so than they would have liked. Inflation has increased quite meaningfully. You are dealing with an environment where inflation pressures have broadened out. They've filtered into inflation expectations, into psychology. So they're trying to fight that, and they're trying to fight that as quickly as they can to get rates to the appropriate level, to kind of that neutral rate, whatever it might be. So they're in a little bit of a rush to do that, and I think that's being reflected in the Fed commentary. At the same time, they're trying to rebalance the economy overall, right? So they want to see some slowing in the economy. They want to get some of that inflation pressure off, but they don't want to tip it into a recession. That's the real challenge.
Absolutely. And Annetta Markowska over at Jefferies was saying she looks at all this and still sees the funds rate, the overnight lending rate basically going to 4% by the middle of next year. Now, there's no way it would make sense to have a 10-year at 3%, if that's true, unless people see the economy dramatically slowing, recession, something like that. So I just wonder if there's still a reckoning to be had in the bond market where we haven't yet decided whether we can skirt recession or not. And it seems like we could easily move a full point in either direction, depending on how the data come in the months ahead.
Absolutely. I mean, look at the bond market volatility in the last few weeks. I think investors are trying to sort out what the right path will be for the economy and for the Fed and how you get to that balance, whatever that, again, might be. So, to me, a 4% Fed funds rate is probably high. For the Fed to actually get to that point, they would have to do so because the economy is so much stronger than they had envisioned. And it's taking that much more to really bring down inflation. And I would argue the recent inflation data, and we'll see what Tuesday, brings in terms of CPI, but the recent inflation signals have been a little bit more encouraging, right? You're seeing some, slowing in wage growth, commodity prices are coming down, inflation expectations are coming down. So, maybe we're getting a little bit relief here where the Fed doesn't have to really push quite as dramatically.
And you also, you're right, exactly. You guys have some spending data, more what should we call it, high-frequency spending data. We're always looking for that on the U.S. consumer. What can you tell us about how they're spending, where they're spending, especially lately?
Absolutely. We're monitoring this all in real time, very actively with the Mastercard spending pulse data. And what we're seeing is nominal spending, actual dollars putting out there into the economy has been continuing to grow at quite a trend-like pace, pretty healthy overall. Now, of course, within that, you're seeing some differences in terms of how consumers are allocating their dollars. There's a bit of consumer choice occurring where in the areas where they've seen some really dramatic inflation shocks, they're, maybe cutting back a little bit in how much they're spending there and looking to spend in other areas which are a bit more affordable. So take gasoline, for example. The huge increase in gas prices has actually led to a drop in usage. Which shows that the consumer is able to navigate this to some extent. Now, it's creating discomfort. They're very aware of these price shocks, but they're still able to spend and they're still able to make these decisions, which I think is really fascinating to watch in real time.
Oh, yeah. And I'm looking through, we just showed some of the figures, but department stores where we're seeing 8.5% growth from last year and 21% growth from 2019. So there is still broad spending happening, in these parts of the economy. Michelle, thanks for bringing this all to us. We appreciate it.